The following presentation is a country risk analysis of the Philippines. Introduction. What is a country risk analysis? A country risk analysis is an analysis done by businesses to determine the risks of a potential trading partner. With the advances in technology today, businesses are looking to enter into new markets in order to reach new customers and gain new market share and gain profit. What country or countries should be considered? Businesses look to expand to other countries in order to reach new customers and enter into new markets. Not all countries are ideal places for business. There are several factors to consider when selecting a country to do business in. One is, what is the infrastructure like? What kind of workforce is present? What industries exist in the country? How does the country's currency relate to the firm's home country? These factors and more will be discussed with regards to the Philippines. Country profile, Philippines. As you can see, we have a map here showing the different islands that comprise the Philippines. We have a little bit about the geography. The area is 300,000 square kilometers. The cities, the capital is Manila with a population of around 11.55 million. We have the terrain is islands. It's 65% mountainous with narrow coastal lowlands. We also have the climate, which is tropical and a stride typhoon belt. People. We have different facts here regarding the people of the Philippines. Their nationality is Filipino. When used as an adjective, it's Philippine. Population in 2009 estimate was 92.2 million. Annual growth rate 2.04%. As you can see, they have ethnic groups Malay and Chinese. They have numerous religions, the dominant one being Roman Catholic at 80.9%. Languages, they have Filipino, and government and education, they use English. You can see a little bit about their education. Their basic literacy rate is 93.4%. Their life expectancy is 67.6 years for men and 73.10 for women. Their infant mortality rate is 25 per 1,000 infants. Government. They have a republic government. Excuse me. Their independence date is July 4th, 1946. They have numerous political parties. They have the Laicist Christian Muslim Democrats and other parties. Suffrage is universal but not compulsory at age 18. Principal government officials. The president is Benigno Aquino III. They have vice president is Jejomar Binay. Ambassador to the United States is Ambassador Willie C. Gah. And Ambassador to the United Nations is Lebron Kabuktuyan. Economy. GNP was $160.6 billion. Per capita GNP was roughly $1,746. Excuse me. A little bit about their natural resources. They have copper, nickel, iron, cobalt, silver, and gold. Their agriculture, they have agricultural products of rice, sugar, corn, pork, etc. Industry, they have textile garments, pharmaceuticals, chemicals, wood products, paper and equipment, etc. Trade, they have their service sector accounts for more than half of their economic output. Industry is about 1/3 of economic output. Agriculture is less than 20%, and they have not really went into mining. Imports, they have 42.8 billion a year. Exports, roughly 38.3 billion a year. Currency. The type of currency they have is the Filipino peso. Excuse me. The relation to U.S. currency is $1 equals 44.14 pesos. Transportation and communication. Land, 203,025 kilometers or 126,154 miles of road, and only 20% of this road is paved. Air, they have 85 public airports and 111 private airports. Sea, as an archipelago, inter-island travel is necessary via watercraft. Major seaports include Manila, Cebu, etc. Transportation and communication continued. Communication. Television and radio. There are approximately 383 AM and 659 FM radio stations and 297 and 873 cable television stations. Newspapers. Major newspapers include the Manila Bulletin, Manila Times, etc. Telephones. They have a sophisticated cellular phone network, and the Philippine Long Distance Telephone Company is the largest telephone company in the country. Now we get into the country analysis part. Excuse me. Globalization. Globalization means that countries are trending toward a more integrated global economic system. This is made possible by reducing trade barriers and also by groups such as the International Monetary Fund and the World Trade Organization. Why do companies engage in globalization? To enter new markets, to gain new customers, and to increase competition. Why should an American firm choose the Philippines? They should choose the Philippines because of reduction in trade barriers with the United States. The Philippines market know American products and they trust them. This will also allow American businesses to gain market share easier than they would in other countries due to the fact that they do know and trust American products. This gives American firms an advantage compared to firms from other countries. International trade theory. Why should countries engage in international trade? Countries who engage in international trade can provide better products to their consumers. Ricardo's theory of comparative advantage. Countries should focus on producing what they're best at and buy products that they aren't as efficient in. With regard to this theory, the Philippines would focus primarily on producing items such as personal computers and other electronic peripherals. The Heckscher-Ohlin theory, or the HOT theory. Comparative advantage arises from differences in national factor endowments. Factor endowments to which a country is endowed with such resources as land, labor, and capital. Goods should be produced using the abundant natural resources, and they should import goods that use resources not available in that country. Based on this, the Philippines' factor endowments are nickel, iron, copper, cement, lime, and marble. Firms who produce products using these natural resources will do very well doing business in the Philippines. Porter's diamond theory involves natural comparative advantage and includes 4 broad attributes known as Porter's diamond. These 4 attributes are factor endowments, which we touched on earlier, demand conditions, relating and supporting industries, and firm strategy, structure, and rivalry. The Philippines meet each attribute of Porter's diamond, so firms doing business here, according to this theory, will be very successful. Entering to the foreign market. How should a country enter to a foreign market? Well, there are 4 basic methods to enter into a foreign market, which include foreign direct investment, exporting, licensing or franchising in host countries, and joint ventures. Each of these methods will be discussed in further detail. Foreign direct investment. Firms invest directly into new facilities in order to enter or gain market share into a foreign country. There are 2 types of foreign direct investment: greenfield investment and acquire or merge with existing companies. Firms should engage in FDI when they want to complete and total control over a facility. Some advantages of a greenfield investment, which basically is starting from the ground up. We have firms have complete and total control over the facility. A weakness to that involves more investment and higher risk. Another strength, firms maintain technological advantage. And a weakness is slower in gaining entry into the market. Some strengths for acquiring or merging with an existing firm include firms get into market share quicker. Weakness to that is risks giving up technological advantage. Another strength would be firms believe they can improve existing facilities. Firms have no control over basic design of facility. Exporting. Exporting is producing goods in one country and shipping them out to other countries for money. When should exporting be used? Exporting should be used when trade barriers are small or non-existent and when transportation costs are low. Exporting is not a viable option for all businesses. Licensing or franchising to host countries. Companies sell a franchise or license, usually something intangible such as a brand name, out to the franchisee or licensee. Franchisees must follow strict rules in order to keep their franchise. If they do not abide by these rules, then the franchisor will take the franchise name away and it will hurt the business. Some strengths and weaknesses of franchise and licenses. Firms avoid many costs and risks of opening a firm. Weakness to that is the geographic distance from the franchisor to the franchisee can make poor quality detection difficult. License. Firms avoid barriers to investment. Firms don't have the tight control over manufacturing, marketing, and strategy necessary to realize experience curve. Firms don't have to incur developmental costs and risks. That's a major strength for this. Firms' ability to coordinate strategic moves across countries is difficult, again due to the geographic location of each franchisee or licensee. Joint venture with a host company firm. Two firms open up a new establishment as joint partners. Makes use of contacts already established by the home firm. Gain advantages by having a partner who has experience in the market. Which method is the best with regards to entering into the Philippines? Foreign direct investment would be the best option for entering to the Philippines because it is transitioning from an agricultural economy to an industrial economy. The firms would not risk losing any technological advantage to a potential customer or competitor. Firms could take advantage of the Philippines being a member of the ASEAN, which is the Association of Southeastern Asian Nations. By being a member of this, businesses in the Philippines have free trade with other members of this organization. Foreign exchange market converts currency from one form to another. This is important because firms want to convert currency from their home country to other countries and vice versa. As we mentioned earlier, $1 US is equal to 44.14 pesos. This is important for American firms because they want to invest because it means their dollars will be able to stretch farther. They will be able to buy more in the Philippines with their dollars than they would here in the United States. This is a chart of the exchange rate of the Philippine peso to the US dollar. It's pretty self-explanatory. It covers 2005 to 2009. International business strategy. Firms who engage in international business must have a strategy if they want to be successful. Companies who are successful find ways to create value for their products. This would not be difficult in the Philippines because they already know and trust American products. Several strategies to be used. I'm not going to go over each one in detail, but here they are listed. We have globalization standardization strategy. Firms should pay attention to how their products are being manufactured. Localization strategy, increased profitability. Transnational strategy. Strategy basically is when firms try to lower costs at various locations. International, firms take products produced domestically and sell them to foreign markets. They're all pretty self-explanatory if you look at them here. Global marketing. Should firms market products in foreign countries the same way they do domestically? The answer is no, because cultures perceive things differently and target markets can differ from foreign countries to home countries. With regards to the Philippines, their culture is very similar to the United States, so they will be able to market very similar to how they do here in the United States. I've already covered this. This is, pricing strategies and everything. You want to be very careful not to price too high or too low. Here's the reasons why. Human resource management. Should a firm expatriate their employees, or in other words, send them from the home country to the new foreign country, or should they hire locals? Well, this is a very good question. The Philippines has a workforce of highly skilled technological employees, so based on this information, they should probably hire locally. In conclusion, after doing a risk analysis of the Philippines, the following has been determined. U.S. firms should consider investing in the Philippines because they have value U.S. products. Philippines is comprised of highly skilled college graduates who can make effective employees. Improving infrastructure allows for a more successful business. And the country is currently in transition from an agricultural economy to an industrial economy, which means they will have less competition if they get in now. This concludes my presentation on the Philippines. Thank you.